is Synovus CEO Kevin Blair. Kevin, welcome back. Good to talk to you again.
Likewise, Carl. It's great to be back with you.
I hope you won't mind if we just dive into credit quality, talk about some of the charge-offs and the degree to which this is going to be manageable going into this cycle.
Well, I think you used the right word. It's manageable. And we've said for several quarters that when you're coming off 5-year lows in both credit cost and some of the credit metrics, that there's only one place for the metrics to go, and that's up. And that's what you're seeing happening. But your word of manageable is how we like to talk about it. When we look at our full year of charge-offs, it's going to be below 30 basis points. And so although that's a little higher than what we've had the last couple of years, that's within our expectations. And in many ways, just like your previous guest, we've looked a lot in our individual asset classes. We've actually seen some improvement. We actually saw our non-performing loans and commercial real estate decline quarter on quarter. So even though there's some pressures and higher interest rates will drive credit cost higher, we believe it's very manageable.
Does it feel right now like the kind of environment you were hoping for coming out of the industry mess in March?
Yeah, well, here's what I feel. I feel like we're focused on controlling the things we can control. And what's happened this quarter is we're starting to bring some certainty into areas that were uncertain. And to your first point, in March of this year, we had bank failures, and there was a lot of questions on whether regional banks would be able to weather the storm and whether they would actually remain solvent. I think we can close the chapter on that narrative. We've actually grown deposits 2 quarters in a row, good core deposit growth. We're able to return to a normal liquidity environment, and so we've closed that chapter. The other question mark that's happened around higher rates is what's going to happen with bank margins. And yes, we're continuing to see our margin contract, but if you just look at the last 2 quarters, last quarter 23 basis points, this quarter 9 basis points, we're actually projecting that the margin will hit a trough in the fourth quarter, and then we have about $30 billion of fixed rate assets, so that will begin to reprice in 24, so the margin contraction will actually turn into margin expansion. So I think we're bringing some certainty into some areas that were uncertain. We haven't eliminated some of the economic risk or the volatility, but I think it's becoming clearer for us, and that is going to allow us to return to a more normal position of growth.
Even with this continued march higher in rates and the higher for longer mantra that continues to reverberate?
Yeah, I mean, rates being higher for banks, I mean, we're asset sensitive to the long end of the curve. So as I mentioned, we're going to see a lot of fixed rate assets start to reprice, which will drive up our margin. It does have the impact of reducing growth. And so loan demand will be muted, just like it is today, given some of the uncertainty. But Sarah, let me share with you a survey that we do every quarter. We ask our commercial clients, and I think this quarter we had about 700 respondents to the survey, and we ask them, what are the prospects for your business over the next 12 months? During the second quarter, 71% of those clients said that they expected their business to be flat or greater over the next 12 months. And even though rates are higher and there's a greater deal of uncertainty, this quarter we had 66% of our respondents come back and say that business would be the same or higher. So relatively speaking, it's starting to decline a little bit, but it's still very positive in aggregation.
Soft environment for loan growth. We've seen it slowing, and I'm curious what you're projecting. Tim Spence told us of Fifth Third last hour that, the plan is to take share. What do you project for loan growth in the coming months and into next year?
Well, what we've said for this year, we'll have around 1% to 2% loan growth for the year, but that's a function. We've had some asset sales. We've downsized certain portfolios. But if you think about Synovus, we're in the Southeast. And so what we've said, through a normal cycle, we're going to grow loans faster than what the underlying economy is growing. So if we're expected to see the economy grow at 2 or 3% in the coming year, we should expect to grow in that mid-single digit level above that. And we have businesses today that continue to grow in mid-single digits. Some of our middle market banking, our corporate and investment banking, and some other specialty areas are actually growing mid-single digit today. The problem is when you look at the pipelines, you look at activities, things like CRE, those pipelines are off 90%, production is off 90%. So when you think about loans as a whole, it's going to be low single digits. But when you think about specific asset classes, we're still growing mid-single digits in some, and in some double digits based on our positioning and our opportunity.